We're going to start with some breaking news. New data coming out just as we come on the air shows that the U.S. economy shrank for the first time in 3 years. The gross domestic product, GDP, for the first quarter of the year is down 0.3%. Markets, of course.
Hi, and welcome back to the 50 or Nothing community. Now you probably are confused. You're seeing the S&P 500 has declined more than 5% year to date. The risk in the market has increased. We're seeing Trump coming out and imposing tariffs on many countries. And you probably are confused. And you're not alone. And my friends have been calling me, asking me questions about, should I sell my stocks, put them in a savings account where it's risk-free and wait for the dust to settle, and then go back and invest in the equity market once risk has decreased? Well, in this video, what I'm going to try to help you is to navigate through this uncertainty. And to be a successful investor, you need to control for risk. So sometimes you need to be aggressive and put your foot on the gas pedal. And sometimes you need to be more defensive and put your foot on the brakes. And whenever an opportunity arises, you need to capitalize on that. So this is something that we're going to discuss, and I'm also going to discuss, what I'm doing in this type of environment. But before we proceed, I would like you to like the video and subscribe. And let's dive in. As always, before we dig deeper, this is not financial advice. Investing in equity securities or any types of bonds always involves risk. You could lose your money, and bonds and stocks prices can go up and down. Now let's take a step back and understand why Trump has come out and imposed tariffs on many countries. And to understand why, you also need to understand that a country is like a company, has a profit and loss statement. They have their revenues and they have their costs. And then they have their balance sheet where they have their assets and they have their debt. The same thing applies for a country where the revenue is a GDP, and then they have expenses, and hopefully they should produce a positive net income. And then they have a balance sheet where they have their assets and they also have debt. Now, if we look at United States profit and loss, we can see that they had a revenue of around 5 trillion and they were spending more than they earned, around 7 trillion. So the deficit is of around $1.8 trillion. And the way they have been avoiding to tackle the deficit is by acquiring more debt, pushing this problem further away. And now the debt to GDP, like GDP is the revenue, right, has increased so much so that the debt is higher than the GDP. It's 123%. And that makes a problem for the United States. So that is the reason to why Trump now needs to figure out how to increase the revenue, or they need to decrease their expenses. That's why they implemented this new Doge project in which Musk was responsible for, to cut government expenses. And then you also have tariffs, which could, increase the revenue for US of around, I think it was 300-400 billion, and then Doge would cut around 300-400 billion. But that's not enough. But now you understand why he's imposing these tariffs. And we could also see that if we look at the financial expenses, is the second largest expense. That's a big issue, because even the national defense is even lower than the financial expense. And of course, it's because the debt since 2004 to 2024 has just increased. It's not rocket science to understand that the financial expenses will just increase. It will be like a snowball effect. Now, what is giving Trump a headache and keeping him up at night is the 10-year government bond yield, the United States. Now you're probably wondering, so what? Well, the 10-year government bond is the future cost for United States to borrow money at. If we look at the 10-year Treasury, we could see that the yield have steadily increased. It was down below the 4%, but now it's around 4.25%. What Trump needs to do is to make this yield decrease, because once he wants to refinance the debt, he could get a lower financial expense. And there's another issue. Much of their debt is short duration, meaning they're coming due quite soon and they need to refinance that debt. That's why it's really important that we could see the government bond yield decline, so that the United States could borrow money at a lower interest rate. Now let's see what Bill Ackman had to say about the short duration of the United States government bond.
So more and more of the longer instruments. And if you look at the balance sheet of the Federal Reserve, it's an imprudent balance sheet. If you think about the United States, right? If this were like a business, you wouldn't have so much short-term. You wouldn't have a third or more of your debt repricing within the next year. So it's not been managed. I think actually Steve Mnuchin did a good job as Treasury Secretary. The one thing he missed is he should have issued a lot of 30-year, 50-year, 100-year paper at crazy low interest rates, and that's going to be a burden.
But here you have Bill Ackman telling us about the short-term duration issue for the United States. They have a lot of debt that is short-term and which needs to be refinanced. And to understand the dynamic of what impacts the yield for a bond, and sometimes it's quite confusing, but when the price of the bond increases, the yields drop, which is good. However, when the bond value decreases, the yield goes up. And normally, in this market turmoil, what many investors do is that they sell equities and they buy bonds. And when the demand for bonds increases, the yield will drop. But we haven't seen that thus far. People are selling maybe equities, but they're not buying bonds. Perhaps they're worried about the US economy and they're buying perhaps more gold. So that is something that we'll need to keep a close eye on, is the 10-year government bond. We want to see this yield decline. Now, looking at the GDP, and what we've seen now in 2025 Q1 is that GDP declined by minus 0.3%. And the reason to that was that, given the Trump news that he's going to impose tariffs, many are taking the chance now to import a lot of goods into the United States before the tariffs are initiated. And, for a government, just so you understand the dynamics, is when you import, it's a cost. When you sell goods, it's a revenue. So you want to have more sold goods than you import. That's why you're seeing this negative GDP. Not only that, to understand what classifies as a recession is if you have negative GDP in 2 consecutive months. So now we have seen a contraction first quarter. If the second quarter is a contraction, then we are in a recession. Looking at the market, because I'm going to answer the question, what should you do? Is the market quite expensive? And again, as I said, we need to control for risk. Should you be aggressive or should you be defensive? So let's go through some metrics that I like to look at. If you look at the Shiller PE, which is taking the entire price of the equities and you divide them by the earnings. And the Shiller PE is also inflation adjusted. And we can see that currently the market S&P 500 is trading at a PE of 34.47. So 34 times earning. So it's not cheap, right? And if we look at crises historically, we can see, whenever the PE has risen above 30, we've seen a sharp decline in the PE ratio, which means a market crash. We could also seen that here in 1930. But with that said, it's really difficult to time a market crash. I don't believe you can do that. I don't believe no one can. And as Warren Buffett says, it's just stupid to even waste any resources on trying to time the market. But now, given that the PE is quite high, I don't think one should be quite aggressive in the stock market at the moment. But now what we're going to do is we're going to look at my favorite metrics, if it's an expensive market or a cheap market. And I'm going to give you an analogy how we're going to do that. Let's take an example. Imagine you buy a house for $1 million and you could rent that house to a tenant for $100,000. Now your yield will be 10%, right? $100,000, which is your rental income, and you divide it by the investment which you bought the house for, which is $1 million. So that's 10%. That's looking at the yield. Now, what happens if you sell your house to someone else for $2 million? And let's assume that the rental income stays the same, $100,000. Taking $100,000 divided by $2 million, we get a yield of 5%. What's happening now is that the yield went from 10% down to 5%, and the reason is because the house price increased relative to the cash flow. So by looking at the yield, we could say that the house price have increased, becoming more expensive. And this example, I'm going to take that and apply that to the S&P 500. And here's how I'm going to do it. Here, I'm taking this data from S&P 500 Global. You could get that. So here you have the S&P 500 market index, which is currently at 5,378. And that will be our example equivalent to the house price. And if you look above, here you have the dividends and buybacks for the S&P 500. And I've taken those from a website called Yardini, where you have an analyst estimating the buybacks and dividends growth going forward 5 years from now. And I've added that, and then year 5, I'm saying that the dividends and buybacks will grow at 8-9%, but then that they will decline to the risk-free rate, because you can't have an economy growing higher than the risk-free rate forever. So these buybacks and dividends will be the example of the rental income for the house that I just talked about. And the yield below, which is R, I'm going to solve for that now to see what the yield is. So if I solve for that, I get a yield for 9%. And if I subtract the risk-free rate, I get a risk premium of 4.78%. So why I'm subtracting the risk-free rate is to see what the investors are demanding to take on risk. As you have understood this example, now we're going to look at this chart, the S&P 500. And as we said, whenever the house price goes up, given the same rental income, the yield will drop. Looking at this blue line, we have the 10-year government bond, the risk-free rate. Here, the yellow is the S&P 500. And the rainbow color line is the equity risk premium. Now, we can see here that before the financial crisis, 2008, the risk-free rate was higher than the equity risk premium. which doesn't make any sense, right? Because if you're an investor and I come to you and I tell you, hey, I have two options. Option A, I can give you risk-free 4.7%. Option 2, I give you only 4%, but you might lose your money. It doesn't make sense for you, right, to take option B. You would take option A. It's a higher yield and it's risk-free. And here, what we could see before 2008 financial crisis, we could see that investors became too greedy. But it took 3 years before the market crash came. And as the house example, once the stock market declined, the risk premium shot up. And you can see here that they diverged, the risk-free rate went down. And we haven't seen this phenomena where the risk-free rate and the risk premium converge until now. Now you could see that in 2023, that the risk-free rate and risk-free premium have converged. But now the good news is that the market decline since year to date 2025 has pushed up the risk premium. So it's higher than the risk-free rate. So that is the good news. But what I'm showing you here is that we saw that the risk-free rate and the risk premium converged 3 years before the financial crisis 2008. What I'm saying is that don't waste your time predicting the market. You never know. But what we could do now is that when we see that the risk-free rate and the risk premium has converged, we need to be more defensive. However, though, if the risk premium goes up to 5 or 6% as it has historically, meaning that the market then has declined, I will be more aggressive and buy more equities. Warren Buffett has sold off a lot of equity stakes, and he's holding now a record of 300 billion US dollars. And he normally, when he sits with this huge amount of cash, he could, buy back shares, but he hasn't done that. And if he hasn't bought back shares in Berkshire, it means that he doesn't even feel that the Berkshire stock is even cheap. So could that be the reason to, why Warren Buffett also is now piling up with cash and feeling that the market is quite expensive? We could see that in my risk premium calculation that, the risk-free rate and the risk premium has converged. So when the risk for a recession increases, there are 3 factors that I closely look at when I'm evaluating a company. Valuation. Is the current stock price trading at a discount relative to the market cap? Number 2, default risk. I want a company with a strong balance sheet. I want them to have enough liquidity to weather a storm. And I want them to have low debt. Number 3, what products are they selling? Is it a discretionary or a non-discretionary product? And for example, a non-discretionary product is food. You need to buy food even though a recession hits. However, though, I don't think you would buy a Louis Vuitton bag if you lose your job. You'll probably survive without a Louis Vuitton bag. So those are the 3 factors I closely look at, especially in this type of environment. And I do that for each company in my portfolio, and I'm also going to share that to my exclusive members in Patreon. To make this more tangible, I'm going to now look at these 3 important factors: valuation, business risk, and default risk. And we're going to look at a company to see if it fulfills these criteria. So, looking at revenue for this particular company, which I have in my portfolio, we can see that the revenue has steadily increased. They have a compounded annual growth rate of 10%. The blue is the gross margin. In yellow, you can see the operating margin. So here you can definitely see that there's no cyclicality. They are selling a non-discretionary product. They're selling even though the market goes up or down. That's check for business risk. Now, if I want to look at default risk, I look at the net debt to EBITDA, which says how many years it takes for the company to pay back their debt. However, though, you see that the net debt to EBITDA is negative, meaning that they have more cash than debt in their balance sheets. So this company has steadily had more cash than debt, meaning they don't even need debt. They have really beautiful cash flows that we can see here to the right. And looking at their cash balance, they have $60 million. The short-term debt is 0, meaning they don't need to refinance any debt soon. And if we look at the cash flows, which is the valuation, this company has produced positive cash flow every year. This is a really beautiful company. And not only that, you need to see that the company is also reinvesting in their business, because otherwise the cash flows will be inflated, right? So even though the company is reinvesting, if we look at this example, 47 million in capex and working capital, they're still producing a free cash flow of 4 million. So this is what I do for each company in my portfolio. I assess the business risk, the valuation, and the default risk, especially in this market environment. Now, to sum up, we answered the first question, why Trump imposed tariffs. And it is because he needs to tackle that deficit, and he needs to bring down the government bond yield to be able to refinance that debt more cheaply. Number 2, as I said, as an investor, you need to control for risk. My favorite metric is the implied equity risk premium, which I showed you, where we could see that the equity risk premium and the risk-free rate has converged as they have before the 2008 financial crisis. So I'm going to be more defensive, and I have around 35% cash at hand and the rest in equities. And I'm saving that cash as dry powder in case a market downturn arises, and I will capitalize on that. Now, if you like this kind of content, what I do is I do deep dives in individual companies, which I feel is a bargain, and I share my analysis to my exclusive Patreon members. And what you get is real-time insights to my portfolio. So all the buys and sells that I do, you get notified directly. And I also share compelling ideas of stocks that is currently trading below their value and where I see an upside. And also what I bring to the table is my financial background. I have an extensive financial background in accounting, and I'm using that to value companies. And that is for only 95 Swedish kronors a month, and there's no binding fee. So if you don't like the Patreon membership, you could cancel at any time. So I hope you liked this video. If you do, please like and subscribe, and I see you next time around.